This is video number 2 for chapter 5. So we're going to look at learning objective 4. Describe methods for finding errors on the worksheet. If any of the columns on the worksheet do not balance, you must find the error before you continue. Check the addition of all columns. Check the addition and subtraction required when extending to the adjusted trial balance columns. Make sure the adjusting account balances have been extended to the appropriate columns. Make sure that the net income or net loss has been added to the appropriate columns. So, objective 5, journalizing adjusting entries from the worksheet. The worksheet helps the accountant organize the end of period financial information, including adjusting entries. The accounts are not adjusted until a general journal entry is made and posted to the general ledger accounts. Journalizing adjusting entries from the worksheet. So this is an example right here, which is very similar, 5-21, figure 5-21 in your textbook. So take a look at it, and this is kind of what it's going to be looking like from your side and from actually whenever you're looking at your adjusting entries in the worksheet. So general journal adjusting entries, June, whatever the date, the 30th day. Adjusting entry is dated the last day of the accounting period. So here's the example for what we just did. So it says supplies expense $60, supply $60. Don't forget that's coming out. Insurance expense is going to the income statement. All three of these expenses are going to the income statement, and then we're pulling these off of our supplies, prepaid insurance, and wages payable. So here's a depreciation expense and accumulated depreciation. This one goes to the balance sheet. This one goes against to the income statement. Explain the cash, modified cash, and accrual basis of accounting. Revenues are recorded when earned. Expenses are recorded when incurred. Recognizes receivables and payables. Offers the best matching of revenues and expenses. The best method of measuring income for most businesses. However, smaller service organizations often use the cash or modified cash basis. So revenues are recorded when cash is received. Expenses are recorded when cash is paid. Similar to the accrual base if there are few receivables, payables, and assets. Can vary significantly if a business has many receivables, payables, and assets. Modified cash basis combines aspects of the cash and accrual methods. A business uses the cash basis for recording revenues and most expenses. Exceptions are made when cash is paid for assets with useful lives greater than one accounting period. If cash is paid for equipment, building supplies, or insurance, these are recorded as assets. And adjustments are made each period as under the accrual basis. Liabilities associated with the acquisition of these assets are also recognized. So comparisons of cash, modified cash, and accrual basis. These are so take a look at this in your table. So notice no entry, but account receivable, there is an entry. Expenses, they are cash. Okay, so then those also are in there. So go through and look at these. End of period adjustment, no entry. And then wages expense, wages payable, just like receivable. No entry, expense and account payable. Prepaid items, no entry, expense prepaid, expense prepaid. And by the way, these are examples of how the journal entries should be done. So this asset will be debited, account payable will be credited. Similarly down here, asset accounts payable, and then cash. So that's payment of assets purchased on accounts. So here's how you do the journal entries. So this is the end of this slideshow. I know the screen's a little bit dirty, but let me bring up the second part of this presentation. Again, this is chapter 5 video lecture. Appendix Depreciation Methods. So prepare a depreciation schedule using the straight line method. This is learning objective 1. Straight line, sum of all year's digits, double declining balance, and modified accelerate cost recovery system. For an illustration in this appendix, we will assume that a delivery van was purchased for $40,000. It has 5 years useful life and salvage value of $4,000. So we take our costs minus our salvage value, which our depreciable cost is $36,000. So this is so 36,000 divided by 5 years gives us 7,200 per year of depreciable costs or depreciation expense. It is often convenient to use a depreciation rate per year. 20% of all assets depreciable cost will be recognized as depreciation expense each year. So 100% divided by useful life, 100% divided by 5 years, or is 20%. Straight line depreciation schedule, here's what this would look like. Times 20%, so 7,200, 7,200, 32,800. So this is the book value of the asset at the end of the year 1. Same thing, 36,000 times 20%, 7,200. Now our accumulated depreciation is 14,400, and now our balance and our book value is going to be 25,600. So, and this is what we do 20% each year. 72 is our expense each year. Accumulated depreciation, once it's fully depreciated, if we sell it, we can only get $4,000. If we get more, then we'd have to say a recognizable gain or a capital gain. If we sell it for below the salvage value, then we say capital loss or gain on sale of loss, or loss on sale. So just keep that in mind. So there's our book value at the end. It says prepare a depreciation schedule using the sum of all years digits method. So depreciation is determined by multiplying the depreciation cost by a schedule of fractions. The numerator top of the fraction for a specific year is the number of years of remaining useful life. The denominator, the bottom of the fraction, is determined by adding the digits of the years of the estimated life of the asset. Depreciation costs times the remaining years, so that's the formula, divided by sum of the year's digits. So this is an example, 36,000, 5 divided by 15. Again, it's sum of all years, which will be 12,000. And then depreciation for that year is 12,000. So the book value is 36 minus 12 will be 28,000. Next year, 4 out of 15, 9,600. 21,600 will be our accumulated depreciation, and our book value will be 18,400. And here it is for years 3, 4, and 5. Again, 36,000 is our accumulated depreciation, and our salvage value or book value would be $4,000. Next one, it says prepare a depreciation schedule using the double declining balance method. The book value is multiplied by a fixed rate, often double the straight line rate. Once the book value is reduced to the expected salvage value, no more depreciation may be recognized. As with the sum of all years digits depreciation method, larger amounts of depreciation are taken in the early years of the asset's life. So here's the example, book value times 2 times straight line rate. So 40,000. So again, remember earlier in straight line it was 20%. Well, you double it, so this becomes 40%. 40% times 40,000 gives us 16,000 of depreciation expense that we can put. Remember, this goes straight to the income statement. So our net income will be lower whenever we use double declining. It'll be used quicker as well. So our accumulated depreciation will be 16,000. So we take that 16,000 away from the 40,000 and we get 24,000. So that 24,000 is our book value times 40%. Again, 9,600. So our accumulated depreciation will be 25,600. And then we take that away. So 14,400 is our book value at that point. And here's years 3 and 4. Notice how it was our depreciation took 1 less year. So instead of 5 years, it took 4 years. And our book value is 5,184, which is a little bit higher than our salvage value. And that's what this says right down here. All right, so in year 5, all we have is 1184. So now we're for fully depreciated. Our accumulated depreciation is 36, and our book value is 4,000. Prepare a depreciation schedule for tax purposes using the modified accelerated cost recovery system. So if you do taxes, these are different styles or methods for accounting for depreciation of assets. Used for tax purposes, the IRS classifies various assets according to useful life and sets depreciation rates for each year of the asset's life. These rates are then multiplied by the cost of the asset. So abbreviation is called MACRS, M-A-C-R-S. A delivery van was purchased for $40,000, has a 5-year useful life and salvage value of $4,000. So the IRS would give this van a 6-year life and no salvage value. So $40,000 times 20%, $8,000. $8,000 is our accumulated depreciation. Subtract that from $40,000, we get $32,000. Now we take 32%, 12,800. So 20,800 will be our accumulated depreciation after year 2. And then we take that away from 40,000 and we'll be at 19,200. And in our last year, 40,000 times 19.20%. Okay, whoa, what happened there? So 100% of the assets cost will be recognized as depreciation expense. So here we go, 7,600, and it goes on, so on and so forth, 11,500, 11,556, and these values are usually given to you by the federal government, as long as it reaches 100%. Depreciation is 40,000, accumulated depreciation 40,000, and our book value at the end of the year is $0. So we can't sell it because there's according to the IRS, and then that comes off our books as well. Okay, so those are the different methods for looking at depreciation and different schedules. Go through, view those videos. Hopefully these help you out. I notice not very many of you have been watching the videos, so please watch the videos. I take time to go through and make these videos. So I hope you have a good day. Thank you, and I hope happy accounting.